Hi, everyone. It's John Pokarova. This is a special general market update. We're going to cover a special year in review. We've been doing these updates for quite a while, almost over a year now, and I thought it might be good to kind of recap the past year, which has been a difficult one. But we want to get right into it, and then we will touch upon what's going on in the general market. This is being recorded about quarter of 12 on Thursday, December 15th. So again, presentations by Rain King LLC, and I am an amateur growth stock investor with probably over 20 years experience at this point. So we're going to do a little bit on the year in review. In particular, we're going to look at some of the general market updates that we've done because there is a collection of different lessons along the way. So we'll go through that in kind of a unique format, and then we'll talk about the general market. Again, big picture. Still a monthly chart as the close of November 30th. This zone between 10,000 and 11,000 still is a holding level on the NASDAQ. And we're definitely in a bear market that's come down plus or minus 30%, depending on the indexes you're looking at. The 10,000 level, as I mentioned, which happened to coincide with the COVID peak, pre-COVID peak, is still there. The question is it going to be tested again? Are we going to make new lows, or is the low from October the low? So let's talk about the S&P 500. This is a daily chart of the S&P. We started off the year that the S&P peaked right around, I think it was January 4th or 5th. And we started what looked like a correction. But by February, we had the Russian invasion, which was a very shock to the market. And we also were able to see that we had three different rallies during the course of 2022. We had a sharp rally in March. We had a rally over the summer, which is shown here in yellow. And then we had the current rally, which started October 13th. The March rally was really a commodity-led rally that started late last year. Growth stocks became really they had been decimated in the first quarter, and it was really turned out to be more of a dead cat bounce in the growth names. By mid-year, though, by June, in May and June, the XLE, the energy stocks, the oil stocks, they topped out. We didn't know that would be the top, but they certainly started to correct sharply. And in doing that, the S&P was holding up better than other indexes because it has a lot of energy names in it. And when those started to come down, you can see the sharp break we had to new lows in June. Summer rally gave a little bit of an opportunity with growth names, but you had to be very nimble and be very careful about adding exposure to your stocks if you were playing some growth names. And all of that came to a screeching halt at the Jackson Hole meeting in August, where the Fed was very, very hawkish, and it really put the brakes on everything as we went into the fall. We had CPI reports that were coming in above expectations in September, and we sold off again, making a new low. Interestingly enough, October 13th, the market started to rally up on bad news of a bad CPI report, which was a clue that maybe the market was going to try and find its footing and rally, of which it has rallied, but it's extremely choppy, very volatile, very tough to trade, depending on your time frame. So the S&P, that's kind of the snapshot of some of the highlights. Now, there were winners this year, particularly some of them in commodities, and I just picked a handful of them here, and you can see some of them had very good years. Now, coal stocks, oil explorers, the refiners, the fertilizers, they're all late economic cycle stocks, as shown on this kind of wheel of the economic cycle. But even these commodity names, basically you had until about May or June. You can see they topped out in June, and then they came down very sharply. And some of them have they formed double tops, et cetera, wide and loose patterns. And other ones have really gone sideways. There's been not much progress in the second half of the year, even with the commodity names. Now, in the growth sector, there are some winners, but I have to say they've been very hard to capture these types of stocks in 2022, just given the overall trend. You'll notice I picked some of the winners here, and you can see, some of these look like good gains, but they were definitely challenging to capture these. essentially for the first 2 quarters of the year, there was really no progress. Again, the opportunistic time was in the summer, but you had to be very, very nimble. And then now we're in the rally we're having off the October 13th low. Some of those names were in medical, solar. There's a few semi stocks that also did well in 2022, but certainly not the norm. So let's get into the year in review. I've been doing these for a year, and I've broken down this section of the video into really 3 parts. The first part is calling the top, the end of the bull market. And then I have in the middle here what I call navigating a bear market. As we recognize we're in one, how do we handle those? And then we have this current rally, which will end up getting into the general market current conditions. So I called back some of the lessons out of these videos, and we're going to go through these kind of unique way where I'm going to basically reference these, almost index them for you, and call out what the lessons were and refer you to the correct videos and encourage you to go back and revisit, rewatch the videos, take some notes, because some of the things we're talking about, they're timeless. They actually apply to the market, in a longer term sense. So I wanted to start really about identifying the bull top. And we're going to get into some of the ways that we did that. In a year that many things did not go well, we did get this one right. We were able to call the top and identify it as it was happening. So I think it's important to spend a little bit of time re-reviewing this particular lesson and how we did this. And I don't say this to, make it sound like I did something, fantastic here. That's not the point. The point is anybody can do this type of work. If you study and watch the market closely, you can identify when a bull market could be topping. So that's the important message here. So we're going to break this down. There were a number of tweets and general market videos along this way, and we're going to go right through this, piece by piece to say what we were seeing and how did we identify this. You should look at the December 5th, 2021 video, and all of the detail is in those videos. So the bull market topping process, you'll notice the market attempted to make a new high. And in November 18th was when I first noticed that something was wrong. And I tweeted about essentially the new high, new lows didn't look right in the tweet. And also by the November 22nd, I hit another tweet on this major reversal day, which I expanded upon in a tweet about how markets top in terms of different sectors and how they tend to roll over gradually. So I want to look at this in a little more detail. What we did back then, this is the tweet, and we looked at the 2007 market. And basically, it's a fairly easy premise. Your more speculative and small cap names will top out first, then your mid caps, and then you don't really have the market top out completely until your large caps, the QQQs and the NASDAQ top out. It's kind of sequential, and this took place in over a 4 or 5 month period. When I looked at it in the current context of late 2021, you can see it's very similar. The IPOs topped out first back in February of 21, then the small caps, and probably the #1 sector or group in the market was enterprise software. And it actually topped out in, I think it was February or March of 2021. And so you can see that deteriorated throughout the course of the year. And at the very end is when we had the large caps still making some highs before they rolled over. So it was a very common script to how a big bull market can roll over. Now, proceeding a little further down in this chart, by November 30th, we identified that there was serious breadth deterioration, and using what I use as new highs and new lows, and I encourage you to go back to this tweet here from November 30th, where I detail that. And by December 2nd, it was very clear that all the growth leaders were breaking down, and I actually drew a cartoon about how gradually the market had mowed down all the speculative names. They were coming for the mid-cap names, and they were basically eventually going to get to the Apples and Nvidias and Teslas in time. So as this started to continue to unfold, the next 2 really critical points of identifying the top were on December 9th, how this correction was different and raised a caution flag. At this point, I believe we had a follow through day in here, and many people thought, oh, this is just a correction and we're going to go higher. But I sent out a tweet on December 9th that I want to look at in more detail to share with you the difference. So this is actually that slide, that tweet, and it looked at 2021, and we had a number of corrections along the way, and some basic breadth showed you the health under the hood. And even though this correction here was more shallow than the previous corrections, under the hood was really, really bad. There was a lot of structural damage that basically told me that this was not a good sign for the entire market. It was not similar to these other corrections. And as the market continued to unwind, on January the 5th, we had this down day here, which I tweeted about, which was a very, very ominous sign. Really, I refer to it as the thin ice is really cracking in the market. By January 13th, we had a very, very feeble rally in the index, and this day right here, which pretty much to me said the nail is in the coffin for the bulls. The market is really vulnerable to a sharp decline, which, as it turned out, we did have a sharp decline within days later. But I encourage you to go back to these videos. It's all in there, and combine them with some of the tweets. And like I said, anybody can do this if they're watching some breadth measures and they're paying attention to the market. So moving ahead, when we got to the first quarter of 2022, the March 27th video, which I've shown here on the chart, is something I think you might want to go revisit, because the teaching moment within that video was we talked about the rally attempt, and we very carefully talked about how it's really important to watch your average cost. You don't want your average cost to get too high, or you'll get hurt on a pullback. So I think that's something you might want to go look at. And on April 9th, the signposts that were clear that we had a couple of failed follow-through days by April 9th. And that usually is an indication that this was going to be a much longer and deeper bear market. And so there's some commentary in the April 9th video you might want to refer to. Now, as we marched along in May, the May 15th video, there were a couple of important teaching moments. One was I shared a whole bunch of information about bear markets and bear market bottoms, and introduced the idea of a market precedent being the 1970s. And I shared this slide below. With inflation, really, really raging, it was not unlike what happened in the 70s. In the 70s, they had a very, very difficult time with inflation. They reacted too slow, and they only did a few things to try and bring it down, and it actually reappeared its ugly head. And so, the Fed this time around is really, really focused. They do not want to let this happen, because inflation went on for a good 6, 7, 8 years before they got control of it by 1982. So when we got to mid-year, this is the July 4th market update. And the teaching moments in July 4th was all about what to look for in market bottoms. So I encourage you to go back and look at some of the things that give you clues that maybe you might have a market bottom, or one is starting to form. July 16th was another, I think, pretty good teaching moment. We talked about when you're looking for bases, what are the key weeks, 3 key weeks inside of a base, and what do they tell you? So that's another one that I would refer you to. You might want to take some notes relative to those. By the time we got to August, where the summer rally was actually starting to peak, I think there's some really good things. August 12th was a good teaching moment. We talked about power trend. What is a power trend? What's a eureka thrust in terms of understanding the strength of a rally? And then by August 26th, probably the key teaching moment was when you're trying to identify the next leaders in a bull market, I talk about type 1s and type 2s. So there's a lot of information there with some historical charts and examples. So the August 26th video might be another one that you want to re-review. When we got into the fall, by October 9th, the teaching moment was we talked about seeing some signs of a positive divergence. So if you don't know what a positive divergence is, definitely dig your head into this particular video. And then by October 28th, the oil stocks had started to rebound, but we really learned the teaching moment was what is the risk and how do late stage bases act and why they are very, very faulty and risk prone. And I used oil as an example. So that's some good teaching stuff in October 28th. And then about a month later, on November 19th, I shared what I called the case for follow through days. After almost a year of being ground down by the bear market, you know, people kind of get discouraged and they say, why do I follow these follow through days? They don't work. These are not useful. They're not successful. I lay out the case today why you need to put your toe in the water on a follow through day, essentially because you don't know which one's going to work and you want to be best positioned when the market does turn. So a lot of good stuff in those videos, and I thank people that have watched them over the year. If you joined at mid-year to watch these videos, go back to the YouTube, and I encourage you to go review them. So let's get into the current market, and we'll try to keep this fairly brief. So this is the Nasdaq Composite, and essentially we've had one leg down, and then we had a short, but a fairly sharp, steep rally at around, call it a 70, 75 degree angle. Then we had another leg down, call it leg number 2. And then we had another rally that was probably, I'd say, roughly at an angle of about 60 degrees. And then we've had this last rally, leg down, where we had the undercut and got to the October 13th reversal. And we've had a very choppy rally, and it has not been smooth and it has not been steep. You can notice the chop just in how the price movement is. And you can see that's only probably about a 45 degree angle roughly. So in a sense, this rally is not as strong as the other two rallies. Particularly the NASDAQ has not even made it back to the 200-day moving average yet. So the question remains, is this low in October the low, which formed leg number 3 to the bear market, or do we have deeper to go to really get a third leg down with some conviction behind it? The other thing that's possible is, it's very possible that we might experience some sideways chop for months, which can be very, very dangerous to a trader. But we might try to bottom and just chop around for months and months, given we are with the economy, inflation, and the Fed rate hikes. I shared this by a tweet a couple days ago, but this is the equity put call ratio. And what we noticed was going into the Fed meeting, there finally seems to be some fear, real fear in the market, where everyone is buying either put protection for long positions, or they're just buying puts because they're bearish, and it's obvious to be bearish at this stage, and they're trying to profit from the bear side. So this is extreme now. We noticed that the equity put call was very, very low when tech was topping, when ARK was topping. So what's really challenging is most people are pretty bearish, and the put buying is up here at an extreme. And frankly, the people that are shorting the market right now, they're probably getting very, very frustrated too, because the market has not broken to new lows. This chop can be really hell for bulls and bears getting chopped up. So I've got the S&P on the left and the NASDAQ on the right. These are daily charts. Just a quick recap. We had the reversal. We had 3 pretty good follow-through days. And then what was interesting was about 2 weeks ago on Friday, there was a really hot jobs report, but the market shrugged it off. So that was actually encouraging. Now, just yesterday, Powell basically continued to reinforce hawkish talk into 2023. Rate hikes are going to keep coming, though they might be at a slower pace. So in the morning, we had a gap down. So this chart, I just clipped this about, an hour and a half ago. Let's see how we close. Doesn't look good right now, but we'll have to see how we finish the week. On the right, again, similar pressure today on the NASDAQ as when this chart was snapped, it was breaking the 50-day moving average. So follow through day number 7, which I've been tracking closely with some data as a signpost. So let's take a look at where we are. The signposts are that we know in studying the S&P 500 that when you finally get the successful follow-through day out of a deep bear market, the first 4 weeks after a follow-through day, the gains are 4.46 in the first 4 weeks and approximately 12% in the first 13 weeks. So where are we? Well, in the first 4 weeks, we're at 5.4, a little bit behind the historical pace. But as the peak that we had just a couple days ago at the 8-week mark, we're up about 9.3%. So it's still good and, quote, following the script. But today, with our gap down, this shows us being about 4.8% off the highs with this pullback. The max drawdown of a successful follow-through day coming out of these bear markets is about 4.65 in the first 13 weeks. So we're testing that right now. We don't know if this pullback is going to get support and we reverse, or if we're going to waterfall down lower. So it's a big test to say, is this going to hold up? Is this follow-through day going to remain valid? So trying to summarize this, the Fed does not want to see a strong market rally, and they'll probably use the Fed governors to talk it down because they don't want market gains. They don't want personal wealth because that encourages more spending, and more spending at this time in the economic cycle is going to continue to fuel inflation, which is their target to bring down. So they don't want to see a strong market rally. That said, we know the market looks 6 to 9 months ahead. The Fed has got to be still very concerned about the labor market. The labor market is still strong, it's still tight, and it's a big, big headwind. The Fed is going to most likely keep going with their rate hikes until they see evidence that the labor market has cooled, not just the CPI number. So there's always Fed lag. They've made a number of increases over the year at a very steep pace. And there is the danger that by the time the Fed sees all this evidence, the hikes may have gone too far and the recession will already be underway. A lot of cross currents. We have tax selling at the end of the year. We have this phenomenon of the Santa Claus rally late in December, early January. So there's a lot of stuff going on. Now, January, as a fresh new year, institutions start to prepare for 2023. So we could see some pretty aggressive sector rotations as institutions sell off their losers and get repositioned for their future year. Now, China reopening their economy is definitely a risk to the whole equation, because if they open the economy in a strong way, it's going to fuel demand. It could reignite higher inflation. So rate cuts might be far, far away from where we think. So January and February's economic data, could spark a deeper sell-off. It's definitely a possibility that January is a pretty ugly month, and we actually test the lows, if not make new lows. But at the moment, from what we see and what we observe, we're watching the follow-through day signposts that I just showed you, and there are still green shots or shoots, is what that should say, in the growth sector. You just have to build your watch list carefully and find the best growth stocks that have good technicals, good fundamentals. There are some showing RS during this fog of the bear market, so just keep an eye on those. So that's my update of the past year. My next update is going to focus on 2023. We all start with a clean slate. January typically is a weak seasonal month. As I mentioned, we'll talk about what to look for to see how institutions are positioning themselves in the first few weeks of the year. And I will share my baker's dozens of names and ideas to watch in 2023. So I'm going to target this video somewhere around December 27th or 28th. So please look for that. And as we round out the year here, I wanted to wish happy holidays to everyone and their loved ones for a really safe holiday season. If you want to reach me, you can see my Twitter and my email. If you want to send me a comment, I'd really appreciate it. And thank all of you for watching these videos. Hopefully they've been very, very helpful to you, and we'll continue to do them next year as we guide our way through this bear market. Thanks, everyone, and we'll see you in a couple of weeks.